Welcome to this video on accounting for retail operations. In this video, we're going to be covering specific transactions that are unique to retail operations. In a merchandising business, such as a retailer, the focus is on inventory. What we see here is a comparison of the income statement for a retail business as compared to a service business. You notice in the service business we have fees earned, which is revenue, minus our operating expenses, which gives us operating income. In the retail business, we divide the income statement between gross profit and operating income. Gross profit represents sales minus cost of goods sold. What we will find out is that our cost of goods sold represents the cost of the inventory that we have sold. Thus, we are able to identify the gross profit related to the selling of the inventory. This is a very important variable, and what we'll see is that we actually use this variable from a data analytic perspective. So not only are we tracking gross profit in terms of dollars, we also want to track gross profit in terms of percentage. The percentage of gross profit is simply gross profit divided by net sales, which gives us a percentage. This percentage is something that we're going to track over time as we are managing our business. The cost of goods sold is a calculation of how much inventory we actually sold. The computation for cost of goods sold is starting with our beginning inventory. Keep in mind that the beginning inventory represents the ending inventory from last period. We then add to this any purchases that we made during the current period. That gives us our goods available for sale. We then do a physical inventory count at the end of the period. We subtract this ending inventory count, and what remains is our cost of goods sold. Over the next several slides, we're going to go through specific transactions for a retailer. The retailer name is TechSource. In this transaction, TechSource purchases $5,000 worth of merchandise for cash on September 3rd. What we see here is that there is a reduction in cash. There is also an increase, a corresponding increase in inventory. The net effect is that the assets remain the same, and because both cash and inventory are current assets, there's no net effect related to our liquidity, which is the working capital. The statement of cash flow shows a decrease in operating cash of $5,000. This is because we are paying for inventory, and the purchase of inventory for cash represents a negative cash flow from operations. There is no net effect on the income statement, and of course there will be no net effect in our profitability for the purchase of inventory. In the next transaction, we're going to consider what takes place based upon this invoice. In this invoice, ABC Printers sells to our company, which is TechSource, 10 printers or fax machines or copiers at a total cost of $1,500. Now, a couple of things that we're going to be talking about related to this invoice is, number one, the terms. You notice that the terms are 2/10 N/30. What this is saying is that the terms are such that if it is paid within 10 days, we receive a 2% discount. Thus, we have the 2/10. The N/30 represents the fact that the item must be paid within 30 days. If it's paid beyond 10 days but within 30 days, we're going to be paying the full amount. The other piece that we will be talking about related to this inventory is the FOB. FOB is free on board or freight on board, and it represents the point of the transaction where title transfers. This is relevant because the title transfer point represents who pays for the shipping. In this case, this is FOB Cincinnati, which is actually the destination. So FOB destination, the seller pays for the shipping charge. Thus, the buyer, in this case, this is TechSource, is not going to be paying for the shipping charge. Let's very briefly go through the credit terms before we look at the transaction. The credit terms were 2/10 N/30, which means that if we pay within 10 days of the invoice date, that we receive a 2% discount. Otherwise, the item needs to be paid in full by the 30th day. In this case, the invoice date was June 3rd. The discount period ends on June 13th. The assumption that we have in all of these exercises is that we will take advantage of the discount period. In this case, if we don't take advantage of the discount period, we will need to pay the invoice in full within 30 days, which is July 3rd. In this invoice, we're purchasing inventory. This inventory is $1,500. However, we are expecting to take the discount, and that discount is 2%. Whenever there is a discount that is a part of the equation, we report everything net of discount. In this case, we have an accounts payable and inventory. Again, the amount is $1,470, which is a 2% discount of the purchase price of $1,500. This has no effect on liquidity or profitability. It has no effect on the statement of cash flow because we are not paying cash. There's no cash transfer in this process. In the next transaction, which occurs on June 13th, which is exactly 10 days later, we pay for the invoice. The invoice is paid at the discounted amount, and we have a reduction in cash of $1,470, and we are paying the accounts payable of the same amount. This will have an effect on the statement of cash flow because we are paying cash. This is considered a cash flow from operations activity and is reported as a cash outflow. This transaction will have no effect on the income statement, profitability, or liquidity. Before we go into the next transaction, let's first look at the documentation. This is an example of a debit memorandum. You notice that the debit memorandum is issued by our company, which is TechSource, and it is to Maxim Systems. In this case, we are returning 10 server network cards for a total return price of $900. In this case, we are not concerned with any discounts, so what we are going to be doing is going to be reducing our accounts payable, which is what we see in the transaction. We're returning $900 worth of inventory, so we are reducing inventory, and the assumption is that we have not yet paid this bill to Maxim. So internally, we are reducing our accounts payable. This is the purpose of the debit memorandum. This transaction has no effect on the statement of cash flow and the income statement because we are both reducing current assets and current liabilities. There is no net effect in liquidity. Let's now look at a sales transaction from TechSource. In this case, what's taking place is we are selling merchandise for cash. This merchandise has a cost of $1,200. The transaction is what we see here. Cash increases by $1,800. This is a cash transaction and there are no discounts. The inventory is reduced by $1,200. You notice that in the income statement, sales is $1,800 and our cost of goods sold is $1,200. Therefore, the gross profit on this transaction is $600. And that's exactly what we see in retained earnings, where there is a $600 increase in retained earnings. Therefore, the income statement is affected by this transaction, and because we received cash, the statement of cash flow is affected, where the statement of cash flow for operations has a cash inflow of $1,800. Let's look at this transaction from the perspective of how it affects our liquidity and profitability. There is an increase in working capital of $600. Working capital represents current assets minus current liabilities. This transaction increased cash by $1,800 and decreased inventory by $1,200. The net effect is $600, and this represents $600 as an increase in working capital. The gross profit percentage is 33%. Gross profit percentage is a key metric retailers track, and the gross profit percentage is simply the gross profit, in this case $600, divided by the sales price, which is $1,800. We had originally talked about purchase discounts. Let's now look at the same type of transaction, but from the perspective of the seller. In this case, TechSource sells $15,000 worth of merchandise on account to Medical Health Services, and the terms are 2/10 net 30. What we are assuming is that Medical Health Center will take advantage of the discount. Therefore, we are going to record the transaction at the discounted amount. And that's exactly what we see here. The sales is $14,700, which is an increase in accounts receivable of $14,700. That $14,700 is simply the $15,000 less a 2% discount. In this case, we are selling inventory worth $12,495. The net gross profit is $2,205. Thus, what we see is the transaction where accounts receivable increases at the discounted amount. Again, we are assuming that the customer is going to take advantage of the discount. We are reducing inventory at $12,495, and the difference is gross profit and is reported as an increase in our retained earnings. Over the next several slides, we're going to be talking about refunds, but sales refunds from the perspective of the seller. In this case, TechSource is refunding money. On August 13th, TechSource pays Krieger Company a refund of $225 for merchandise damaged in shipment. Notice that the merchandise was damaged. Therefore, the merchandise is not going to go back to inventory. The transaction is such that we have a reduction in cash because we are paying back the customer, and in addition, we are creating a customer refunds payable account. This customer refunds payable account will be reconciled at the end of the period, but at the point of transaction, which is all we're concerned with, is we're creating this payable account. As an internal control, we need to document this credit to the account. In this case, we are creating a credit memorandum. Within the organization, this credit memorandum needs to be signed by a supervisor, and what we're doing is we are using this credit memorandum to pay the customer. Thus, we are documenting this as a credit, and this documentation is proof that a supervisor has actually reviewed the transaction. Let's now look at a return where the merchandise is returned and is sellable. In this case, on September 2nd, Wallace Company returned the merchandise to TechSource with a sales price of $4,000 and a cost of $3,000. When we look at the transaction, we are working through this transaction through what we call an indirect method. Therefore, there is no effect immediately on retained earnings. However, these accounts are going to be reconciled at the end of the period. Because the customer is returning merchandise, we are reducing their accounts receivable by $4,000. There is inventory that we received worth $3,000. That goes back into inventory. Inventory is increased by $3,000. However, the next two transactions, or the next two pieces of the transaction, are a little bit different. We have an estimated return inventory, which is a reduction in inventory. It's treated as a contra account that reduces our total inventory amount. In addition, we have the customer's refund payable, where we have the payable of $4,000. The transaction is in balance. And what we will be doing at the end of the period is reconciling all of our estimated returns and refunds payable and have a net effect on retained earnings. Thank you very much for your time in this video. In this video, we covered specific transactions related to merchandising. We will continue this discussion in our next video.